Welcome to the Deep Dive. We're here to cut through the noise and find the signal you can actually use.
Glad to be here.
Today, we're really plunging into the wisdom of, well, one of the greats, Warren Buffett. Hugely successful, enduring investor.
Absolutely. A legend.
Our source material for this is a great set of excerpts from a YouTube video transcript, Buffett himself, just sharing his journey, his core ideas.
Yeah, some really candid stuff in there.
So our mission today, let's try and distill these powerful philosophies he has. On investing, sure, but also success, modern life, some surprising takes in there.
Definitely.
We want to hand you some, crucial nuggets of knowledge, things that might genuinely shift how you look at things.
Sounds good.
Okay, so to kick things off, get this. Warren Buffett's first investment, he was just 11 years old.
Incredible, isn't it?
Yeah. Back in 1942, he put $14.75, which he says was every penny he had, into 3 shares of City Service Preferred.
And that little story, that 1475, it's more than just a fun fact, right? It's like the starting point.
How so?
Well, it shows that even giants like Buffett, they started out with the same assumptions most people do. Often kind of misguided ones.
Ah, okay.
His whole journey, that transformation from just like picking stocks to becoming this legendary business owner, it wasn't instant. It was an evolution.
Right.
And it's a powerful reminder for all of us, I think, that real understanding often means unlearning things first, those flawed ideas we pick up.
Okay, let's unpack that initial approach then. For the first, 8 years? Starting at age 11, he was all about watching stocks go up and down.
Yeah, the ticker tape watcher.
Exactly. He was charting them, reading all these books on technical analysis, like Edwards and McGee, Garfield, R.W.
Classics of that field, yeah.
Believing the key was to predict what a stock would do, predict the stock market itself.
Which raises a big question, doesn't it? How deeply ingrained is that urge, that sort of flawed idea of predicting the market's next move? It seems so common.
It really does. But then, and this is where it gets really interesting, the big shift, his pivot. He was about 19 or 20, reads Ben Graham's book, The Intelligent Investor, and bam, realization hits. He was doing it exactly the wrong way.
And that's the core of it, that profound change in mindset. He says from that moment, he never bought another stock.
Right?
Instead, he bought businesses that happen to be publicly traded. He became an owner of a business.
Completely different frame.
Totally. And it meant he did not care whether a stock went up or down the next day or the next week or the next month or the next year.
Because it didn't matter to the underlying business, necessarily.
Exactly. He didn't care what the stock market would do in the short term. The focus shifted entirely to the business itself, its value, its future earnings.
It really simplifies things mentally, doesn't it? If you can actually detach from that daily noise.
Hugely.
Okay, so this owner's philosophy, how does it play out in practice? He emphasizes he's never had less than 80% of his money in American business.
Always. Seeing them as actual businesses, yeah, not just ticker symbols flashing.
And he even says he doesn't really want to own much else. Beyond his home, things for his family, he's quite clear. More stuff doesn't equal more happiness for him.
Which is kind of countercultural in many ways.
It is. And speaking of counterintuitive, this next bit might throw some people. He says he feels better and happier when stocks are going down.
Yeah. That's the one that makes people scratch their heads.
Right. How do we unpack that for someone whose first instinct is panic when the market drops?
Well, it sounds like a paradox, but if you follow his logic, it's simple. He feels better because a downturn lets him buy more of them with the same amount of money.
Okay. More shares of the businesses he likes.
Precisely. He used that analogy of a farmer, right? A farmer wants farmland prices to go down so they can buy more acres cheaper.
That's a great analogy, yeah.
The investment game, as he puts it, is very, very, very easy if you have the right lessons in your mind about what you're buying.
So it's about the mindset again.
Always. He even suggests people would be so much better if they actually didn't have a stock market. If they just bought businesses privately, like you'd buy a farm or an apartment building. Focus on the asset.
Interesting thought experiment.
And this mindset, it fosters patience. You recognize that the really good opportunities, the times you can act and do something really intelligent, they don't come along every day.
Right.
Maybe once every 10 years or once every 20 years, he says. Depends on your field, what you know. You wait for the fat pitch.
That farmer analogy really sticks, though. Reframing a dip from panic to opportunity. It's powerful.
It is.
So what about success outside of just investing? Does this thinking apply elsewhere?
He definitely connects it. A big thing for him is finding your passion, loving what you do.
That provides the motivation, he says.
Exactly. He describes himself simply as a bright guy who's terribly interested in what he does, and he spent a lifetime doing it.
He also mentions surrounding yourself with the right people, people who bring out the best in you.
Yeah, that's crucial. And then there's his take on intelligence, which is really quite striking.
What does he say there?
He basically says, you don't need to be a genius in his field. He thinks a 120 IQ is plenty.
Really?
Yeah. He says a 170 IQ doesn't do any better than 120 and, get this, may do worse.
Worse. Why?
Because it's not about raw brain power. It's about having the right orientation, the right temperament, emotional discipline, long-term view, that stuff matters more than pure intellect in investing, according to him.
That's a huge takeaway. Temperament over genius.
It really is. For anyone aiming for long-term success, really, not just in finance.
And it's striking that he still thinks, even now, that 90% of the people who buy stocks just don't think about them the right way. They're stuck on those short-term gains.
Yeah.
So if the right way owning businesses long-term is relatively simple conceptually, why is it so hard for most people to actually do?
Well, I mean, human nature, right? We're kind of wired for instant gratification. The market's always flashing prices, tempting you to react now.
True. Hard to ignore the noise.
It takes incredible discipline. Plus, Buffett mentions his own drive, that when he decides to do something, he wants to do it big. An all-in, long-term owner's approach.
And personally, what makes him happy?
He says, quite simply, what makes me happiest is what I'm doing. That intrinsic satisfaction. And he also really values being trusted by people.
Ah, interesting.
Yeah, he prefers working with partners, even if maybe he could make slightly more money alone. That relational aspect is important to his satisfaction.
Okay, let's shift gears slightly. His broader views, reflections on the American economy. He's famously optimistic.
Deeply optimistic. And it really underpins his whole investment conviction.
He observes that, a greater percentage of the American population is wealthy now or having more income now than they've ever had, cites things like lower mortgage rates.
Yeah, looking at the long arc.
And here's that fact that really stuck with me. He asserts that the bottom, say, 2% to 5% of income earners today, and certainly the top 1%, they all live better than John D. Rockefeller was living when I was 6 years old.
And Rockefeller was the richest man in the world then.
Exactly. It's an astounding claim when you first hear it.
But then he details the improvements he's witnessed firsthand, right? Medicine. He mentions dentists didn't even use Novocaine when he was born.
Wow.
Education, entertainment, sitting with a big screen TV, watching football replays, instantly, transportation. He just finds the amount of change in one lifetime astounding.
And for him, this isn't just like nostalgia. It's the engine he's investing in.
Precisely. The fundamental progress.
When you look at the sheer scale of it, the U.S., historically maybe half of 1% of the world's population,
Tiny fraction.
now possesses 20% plus of all the bounty in the world. It's just incredible economic success.
And that historical context, again, it's not just trivia for him. It is the engine, American enterprise, that resilience. That's the bedrock for owning businesses here long term. Makes a daily market gyration seem, well, less important.
He speculates about why, too, doesn't he? Not necessarily harder work or higher IQs.
Right. Maybe something about being self-selected in terms of enterprise, he wonders. That willingness to take risks, perhaps.
Yeah.
He uses this great image. Imagine telling someone at the Constitutional Convention in 1789 what America would look like just 3 more of your lifetimes later.
They wouldn't believe you.
They'd think you were crazy. Describing airplanes, watching sports instantly from across the globe, modern medicine.
It puts things in perspective.
Absolutely. He concludes that what an hour of labor delivered 100 years ago versus now.
Yeah.
It's unbelievable. And those great inventions like Edison's, they belong to us now.
Yeah.
We all benefit from that cumulative progress. It's a really powerful long-term view.
So, okay, let's try and wrap up this deep dive. Key takeaways from Buffett's wisdom. We've covered that journey, right? From stock predictor to true business owner.
Huge shift.
The power of patience, actually loving what you do.
And that temperament point, yeah.
And his really profound, optimistic take on American progress over the long haul.
Definitely.
So as we leave you to think about all this, was it maybe a final thought?
Well, maybe something to mull over is this. As you navigate your own choices, financial and otherwise, what businesses are you truly owning for the long term?
Good question. Both investments and maybe personal projects.
Exactly. And how can you cultivate that right orientation, that Buffett temperament, to embrace the long game, especially when all the short-term noise tries to pull you off course? How do you stay focused on what really matters?